First, I'd like to introduce Team 2. My name is Hayden. We also have Laura and Arunya. And we'd like to take this opportunity to thank Waffle House for letting us perform a thorough strategic evaluation in hopes of providing some solid feedback and fresh insight regarding internal and external factors that affect the company. Our evaluation has led us to some top strategic concerns for the company, as well as some ways to overcome those concerns. Before we would begin, we'd like to touch on a few elements we have discovered about the 62-year history of the Waffle House brand. So some background here. Waffle House first opened its doors to the public in 1955. Founder Joe Rogers and Tom Faulkner were neighbors in an Atlanta suburb who decided to build a restaurant based on high customer service with a short order concept. This was the beginning of the Waffle House brand. By 1961, the company had 4 restaurants in the Atlanta area. Today, the company has grown to 1,800 plus restaurants, concentrated mostly in the eastern United States. With the help of 60,000 plus employees, Waffle House operates 24/7, 365 to provide its customers hot meals for any occasion. One unique feature of Waffle House is the extensive disaster management plan with on-site portable generators and positioned food as well as ice ahead of severe weather events such as a hurricane. This preparedness and ability to serve food even at limited capabilities is even observed by FEMA and is recognized as a worthy measure of disaster recovery known as the Waffle House Index. The index has 3 levels based on extent of operations and service available at the restaurants following a storm. The green level is when the restaurant is serving a full menu, indicating the restaurant has power and damage is minimal. Yellow means the restaurant is serving a limited menu, indicating there may be no power or power only may be uh, derived from a generator and or supplies may be low. The final level is red, which indicates they are closed, which usually means severe damage. Experts deem Waffle House as a leader in significant risk management and disaster preparedness. Finally, the company prides itself on utilizing America's best brands such as Jimmy Dean, Coca-Cola, Sara Lee, Heinz, Smithfield, and Minute Maid. With an average storefront sitting on just zero point 0.6 acres and an open kitchen concept, these brands are easily identifiable by consumers. This keeps the experience personable and drives a customer-friendly approach. Next, we will move on to the strategy. In order to provide Waffle House with a valuable strategic analysis of the corporation, it was decided that a keen focus of the fast casual restaurant industry would be the most beneficial. We honed in on this specific industry because the entire restaurant industry is simply too broad and unfocused to derive true comparisons for Waffle House. For reasons to be uncovered more in this presentation, we recommend Waffle House to move away from a broad cost leadership strategy and move to a more integrated business strategy. Waffle House will find success in this because they already are successful in being a low cost leader. However, based on our analysis, we found that additional revenue and a better brand perception can be achieved through offering unique menu items, fresh experiences, and potential retail options to set Waffle House apart from its competition. This strategy will encourage more brand loyalty and reach out to other potential customers. This new strategy can be successfully implemented at a relatively low cost. Now I'll pass the presentation to Aronia.
Thank you, Hayden. My name is Aronia, and I would be taking you through the next few slides that discuss the Porter's Five Forces model and the driving forces for Waffle House. We have used the Porter's Five Forces model to assess the relative strengths and weaknesses of the various forces with a mindset of finding the strong or the weak force. We really want the forces to be weak or low for a firm or a business to remain in the industry or to stay competitive. The first force in this model is the intensity of rivalry. The intensity of rivalry is considered to be very high in the restaurant industry because the industry has many firms of various sizes such as McDonald's, Starbucks, Chipotle, and the local mom and pop fast food restaurants that compete for market share. The industry concentration ratio, which suggests that if the market share of the four largest firms in the industry is greater than 70%, then the industry is considered to be concentrated. According to the data provided by Waffle House executives, the industry concentration ratio of the top four U.S. restaurant operators was calculated to be over 90%, suggesting that the industry is concentrated with firms that want to increase their market share by attracting their competitors' customers. The next factor that intensifies the rivalry are the fixed costs. The fixed costs for Waffle House are considered to be low because buildings are all but paid for in cash. However, restaurants such as Waffle House have high storage costs and perishable products that further intensify rivalry among firms in the industry. Switching costs are considered low because customers can easily transition to other restaurants such as IHOP or Wendy's without needing any real motivation. The final determinant of the rivalry intensity are exit barriers, which are considered low since opening or operating a restaurant does not require specialized assets and all is needed are sufficient capital to purchase or rent a space, equipment or furniture, and some additional working capital to buy ingredients, pay employees, and pay utility bills. Therefore, we consider the intensity of rivalry to be very strong for Waffle House. The next force is the bargaining power of buyers. When the bargaining power of buyers is strong, they can essentially set the price. In the case of Waffle House, customers demand high quality food coupled with a unique dining experience and superior service at a reasonable price. Therefore, customers can easily impose their demands on Waffle House, and because they have a wide selection of restaurants to choose from and their switching costs are low, the bargaining power of buyers is considered to be high. The next force in this model is the bargaining power of suppliers. There are various suppliers to Waffle House, which include Basic American Foods and Royal Cup Coffee and Tea. Waffle House relies on its suppliers for food items, packaging, tableware such as napkins, cutlery, plates, and these products are not considered to be an essential part of the buyer's business and therefore are not differentiated. Moreover, there are a large number of alternative suppliers in this industry to which Waffle House can turn to if dissatisfied. Because suppliers are operating in a very competitive environment, they will strive to keep the prices and costs down. Therefore, the bargaining power of suppliers is deemed low in the case of Waffle House. The threat of substitute products is the next force in the Porter's Five Forces model, and this is deemed to be high. Waffle House faces considerable threat from substitutes such as home cooked meals, convenience stores, and supermarkets. It faces a considerable threat more so from convenience stores and supermarkets because they compete on the basis of both convenience and value with Waffle House. The last force in this model is the threat of new entrants. This is considered to be moderate in the case of Waffle House. There are certain factors that lower the entry barriers. In the case of Waffle House, although the entry and exit costs are low, restaurants do not have the technological requirements that would be required for a high-tech firm. There are relatively lower fixed costs. The premises and equipment, furniture, fittings can be leased, which lower the capital cost, outlays, and borrowings. Also, the food processing and preparation equipment is readily available, which lowers the entry barriers for new entrants. The learning curve is not as steep. However, federal regulations such as healthcare, data security, dietary guidelines, food waste, restaurant tax laws all contribute to increasing the entry barriers. So, all in all, the threat of new entrants is considered to be moderate for Waffle House. In summary, we see in this chart that the threat of new entrants is moderate, the bargaining power of suppliers is considered low, bargaining power of buyers is high, threat of substitute products is deemed high, and rivalry among competing firms is also deemed high. For this project, we have identified four driving forces which are nothing but the external environmental conditions that drive changes in the industry. The first one is changing customer preferences. We see that there is a growing trend toward healthier and organic food choices. People are adopting vegetarianism or going vegan. Millennials are reshaping the restaurant industry. Uh, this is true because millennials now account for about a quarter of the total US population. Their ratio is predicted to grow to 40% over the next few years. It has been reported that millennials eat an average of 4 times a week at fast casual restaurants, and this makes them the fastest growing consumer segment. There are four factors that drive the needs of this group because these millennials tend to be frugal but will pay for quality. They are environmentally and socially conscious, they're tech savvy, and they're more open to new ideas and experiences. Therefore, millennials tend to gravitate towards businesses that share and exhibit similar attitudes environment, locally farmed produce, sustainability, and other social causes, and this is considered to be a significant driving force for Waffle House. The second driving force is information technology. The adoption of IT would facilitate online ordering, would allow customers to avoid waiting in line, and it also permits faster and easier payments. With the use of IT, Waffle House can get immediate customer feedback, and that would help them recognize future opportunities. The third driving force is the growth in fast casual restaurants. It has been reported that the growth in fast casual restaurant chains increased by 11.4% in 2015, and the growth is projected to increase by 3% in 3 years from 2015 to 2018. The last driving force is the competition. Waffle House faces stiff competition from fast casual restaurant chains as well as local mom and pop eating joints. Then it is also true that it also faces competition from supermarkets and convenience stores, and this was discussed in the thread of substitutes in the Porter's Five Forces model. So these are the four driving forces that we have identified for Waffle House. I will now give it over to Laura, who will be discussing the key success factors and the SWOT analysis for Waffle House.
Now we will uncover some financial comparisons for Waffle House. For the purpose of comparing some financial data, we have chosen to look into we feel to be a what we feel to be solid competitors that fall under the fast casual restaurant umbrella. We have provided some financial ratios we would encourage Waffle House to observe and benchmark against their own. These numbers are here for just comparison's sake and do not provide anything other than some financial comparing points of reference for Waffle House. All ratios must be sensitive from a relativity standpoint, and further evaluation and understanding may be needed to have some comparison attributions. In our written analysis, we have provided charts and definitions for further comparison and understanding. We hope Waffle House will utilize the information provided to help make some sound business choices to improve operating margins and drive revenue. We have also introduced in our written analysis the concept of same-store sales, which is a financial metric that retail companies use to evaluate the total dollar amount of sales in the company stores that have been operating for a year or more. Examining same-store sales figures is helpful to investors in determining what portion of the company's current sales revenues are a result of sales growth in existing locations, and what portion is accounted for by the opening of new stores. Since Waffle House plans to increase the number of Waffle House restaurants from 1,800 to 3,500 in the foreseen future, estimating same-store sales would be an added benefit. I will now turn it over to Laura for our strategic concerns portion.
Thanks, Arunya. I'm going to go ahead now and dive into those key success factors for fast casual restaurants. Number one, fast casual restaurants need to offer their consumers good experiences. This includes everything from a clean restaurant, happy and helpful employees, and quick and accurate service. Because we all know that one bad dining experience can really ruin the future relationship with the consumer and prevent them and everyone they tell from coming back again. Number two is a high quality product. It's imperative that these fast casual restaurants produce high quality food and beverages that their consumers enjoy and keep them coming back again. Number 3 is an easily accessible location. And this is very critical for these restaurants because they're unique in the fact that they offer their restaurant goers quality food, fast service, low prices, and a more comfortable location. So therefore, they really need to stand out from a crowd during mealtime. So in order to offer an easily accessible location, it's important to offer ample parking, nice seating, and they need to be easily accessible by highways and major intersections. Some good examples of this include retail-heavy areas, university towns, business districts, etc. And last but not least is marketing. Believe it or not, marketing can actually do a lot for your business. Even though you may be a restaurant that has a sign out front indicating you are a restaurant, people, quite frankly, just need to know who you are and what you do. And with so much competition out there, you really need to stand out from the crowd and let people know why they should eat at your restaurant. And this is especially important for new restaurants that people might not know who you are yet. But for those more tenured restaurants, this is a great opportunity to advertise specials on menu items. And in fact, advertising can actually help you have an effect on overall brand perception. And next, we'll take a deeper dive into Waffle House specifically by looking at their SWOT analysis. So first, looking at strengths, number 1 is accessibility. Waffle House is open 24 hours a day, 7 days a week, 365 days a year. Not to mention, there's a plethora of locations, 1,800 plus nationwide and growing. Plus, these are mostly located in the Southeast region. Not to mention, they're located often right off the interstate, making them easy to swing into for a quick and quality bite to eat. Next, this is a very well-known brand. People know who Waffle House is in the Southeast. And also their signage alone lets people know that this is a restaurant, probably a diner, and they sell waffles. Next, Waffle House is a debt-free organization, which is almost unheard of in this day and age. But they pay everything with cash, so this really speaks to their financial strength. Waffle House also offers superior customer service. They have a dedicated customer service hotline where customers can actually address their concerns and they will be called back within a 48-hour time frame. And last but definitely not least here is the affluent management opportunities. Waffle House offers a very competitive salary for managers right out of the gate, as well as a very nice stock option plan. In addition, there's a clear path of succession that's laid out for managers so they know the next steps that they can take in order to grow with the company. In terms of weaknesses, we did uncover that there is a lack of marketing. There's actually only social media usage, and there's no money spent on advertising. So there's little to no opportunity here to enhance or alter brand perception and let customers know about new offerings or even attract new customers who have never experienced the brand. Next is the high employee turnover rate. So the turnover rate for first-year managers is 30%, and the turnover rate for associates is 140%. This causes a major staffing problem and can also hinder restaurant performance. Next is slow IT adoption. As stated by the Waffle House executives, Waffle House is not an early adopter in terms of information technology, and in the era we live in, IT is omnipresent and helps businesses transform and allows them to connect better with their customers. And even though Waffle House is a debt-free organization, they don't have any financial leverage here. So by that we're saying that in order to enhance their earnings, maybe take a little bit more risk, they would actually have to incur some debt in order to, say, be the first mover in a particular area buy up a property and start the restaurant. So this is contributing to their slow growth strategy. Next is the hierarchical structure. The corporate governance structure of Waffle House contains a lot of hierarchical levels, which thus introduces bureaucracy, can create communication difficulties, and just because there are so many layers to this structure, this can cause associates to feel very low level and out of touch with decision makers. So now let's look at the external factors. We'll start with the opportunities. So there is a very good opportunity here to start strategic marketing campaigns. Now this will really help them change their public perception about their restaurant quality and experience. And also it can help them create a marketing campaign about their management opportunities and how great of an opportunity it is for recruitment and growing someone's career path. Next, diversification in menu options. Waffle House can offer their customers unique menu options like holiday specials, as well as healthy or organic menu options. Next, we think that Waffle House should offer their customers a unique experience. Keep this term waffle hour instead of saying happy hour. And this is really just something that Waffle House can do to increase the flow of customers at typically slow hours. Next, we have retail branded items. There are a lot of diehard Waffle House fans, and thus tapping into the retail branded item market is a pretty good idea where they can actually sell in-store items like branded coffee mugs, coffee grounds, and even waffle mix. And next is a phone app. Incorporating a phone app allows for easier ordering, and it can even create a rewards program for frequent customers. And again, as stated earlier, in terms of technology, this actually helps enhance customer loyalty. In terms of threats, Waffle House faces a lot of competition from other fast casual restaurants like Cracker Barrel, Denny's, IHOP, Starbucks, which obviously affects their margin. Waffle House is known to be an inferior restaurant, unfortunately, by the second public, which can lack in lost revenue and lack of brand loyalty. Next is the rising cost of real estate. The cost of owning land is rising substantially, so it makes it harder to purchase a new location. There is a social trend towards eating healthier, and Waffle House isn't particularly known for offering healthy food items. And lastly, there is a lack of prestige associated with management careers. And this can negatively impact the recruitment of college graduates for management opportunities.